Okay, so gold. It's always had this incredible allure, hasn't it?
Hmm.
Often seen as the ultimate safe haven, especially, when the economic waters get choppy.
Hmm.
But for those looking to invest, I guess the big question is, does that safe haven label really tell the whole story?
Yeah, that's a great point. And a key insight from the material we looked at is that while gold does hold a unique place in a diversified portfolio,
Yeah.
it's absolutely critical to move beyond just that traditional perception and truly grasp its inherent complexities. The old saying, all that glitters is not gold, well, that holds particularly true for its investment profile. It's not risk-free.
Right. So our mission today is really to cut through some of that noise. We want to give you, the listener, a kind of shortcut to being genuinely well-informed, helping you understand the truly important nuggets from our source material so you can make sense of how gold might or, might not fit into your own financial landscape. We're doing a deep dive into the real risks involved in gold investment and, crucially, effective strategies to navigate them. And we're drawing from an insightful piece by Doug Young from the Gold IRA Company's Bulletin. It's an independent market research and educational resource. The piece is titled, What are the Risks Involved in Gold Investment? Hmm. So, okay, if gold isn't quite the universally risk-free asset some perceive it to be, where do these underlying risks actually emerge from? What should we really be watching out for?
Well, this raises a really important question. What exactly are we guarding against when we consider adding gold to our investments? The article points out four primary areas of risk that every investor really needs to be aware of, both to minimize potential losses and, on the flip side, to maximize returns.
Okay, four key areas. What's the first one?
The first and probably the most obvious one is market volatility.
Ah, right. The price swings.
Exactly. Gold prices can be, well, pretty volatile. They're subject to significant fluctuations, influenced not just by broad market conditions, but also by subtle shifts in investor sentiment and macroeconomic indicators like interest rate expectations or, geopolitical tensions. All this stuff can lead to rapid and sometimes kind of counterintuitive price swings.
And what's interesting there is, you think back to the 2008 financial crisis, right?
Hmm.
Gold prices soared then as investors rushed into those safe haven assets. But the article also highlights that its value can actually plummet during periods we'd normally consider quite stable.
That's right. It's definitely not a one-way street.
Yeah. And this rapid fluctuation, it can be particularly challenging for, say, short-term investors, right? People who might need to liquidate their assets quickly.
Absolutely. If you need the cash fast, that volatility is a major risk factor. Another crucial area the source shines a light on is inflation impacts.
Okay, inflation, how does that affect gold?
Well, inflation can significantly erode the purchasing power of your gold holdings. Essentially, it diminishes its real value over time if the price doesn't keep pace.
Right. So let's say you bought gold for, I don't know, $2,500 an ounce, and then inflation rises by 5%.
Hmm.
Your gold basically needs to appreciate by at least that 5% just to maintain its original purchasing power. If it doesn't, you've effectively, well, lost money in real terms.
Precisely. But what the article also highlights as a sort of crucial nuance here is the inverse relationship.
Okay.
When the value of currency decreases, the price of gold very often increases.
Oh, right.
So this inverse relationship can actually be a powerful protective mechanism.
Yeah,
It helps shield your purchasing power against that inflationary erosion we just talked about.
got it. So it can cut both ways with inflation.
It can.
Okay. Beyond economic indicators like inflation, what about the broader global landscape?
Yeah.
How do geopolitical factors play into gold's risk profile?
Geopolitics. Yeah, that's a big one. Events like wars, political instability, sudden changes in government policies, these can trigger immediate and, frankly, unpredictable shifts in gold prices.
Right. You often see prices jump during unrest.
Exactly. We often see gold prices increase dramatically during periods of geopolitical unrest because investors, quite understandably, seek out those perceived safe haven assets.
But it's kind of a double-edged sword, isn't it?
It really is. These same events can also lead to equally rapid declines in gold prices once the situation stabilizes or appears to stabilize.
So you really have to stay on top of things.
It really underscores how staying abreast of global events is absolutely crucial for any gold investor. You can't just buy and forget.
Definitely. And finally, you mentioned four risks. What's the last one? Sounds like one maybe newer investors might overlook.
Yes, counterparty risks, specifically in paper gold.
Paper gold. So you mean things like ETFs or futures contracts?
Exactly. If you're investing in the synthetic forms like gold ETFs, which track the price but you don't own the metal, or futures contracts to buy or sell later, you face the risk that the other party, the counterparty,
Uh-huh.
defaults on their obligations.
Okay, so the institution managing it could run into trouble.
That's a vital distinction from owning physical gold, yes. This can happen, for instance, if the financial institution managing the ETF or the futures contract faces severe financial difficulties. And what's also important to note here is that paper gold investments can be subject to leveraging.
Using borrowed money.
Essentially, yeah, using borrowed capital to try and increase potential returns. But the flip side is it amplifies both your gains and your losses. It adds this whole other layer of risk that just isn't present with owning the physical metal.
Wow, okay. That's a lot to consider on the risk side.
So with all those risks in mind, the key question becomes, how do we actually do something about them? Because the article isn't just about identifying problems, right? It offers concrete strategies to minimize losses and manage risk effectively. Precisely. And that's the constructive part. Effective risk management isn't just about, acknowledging the potential pitfalls. It's about actively implementing strategies to mitigate them, to make sure your gold investment truly aligns with your broader financial goals.
Okay, so what's strategy number one?
Well, one of the most straightforward ways, according to the source, is actually investing in physical gold.
The actual bars or coins?
Yeah. Investing in physical gold provides a tangible asset, something you can hold, something you can store securely. It offers that sense of direct ownership that paper assets just don't.
Makes sense.
However, it's essential to consider the direct costs, associated with purchasing, storing, and insuring physical gold.
Right, storage isn't free.
And for your peace of mind, always ensure you purchase from reputable dealers. You really want to avoid counterfeit products.
Good point. And I think you mentioned something about size.
Yes, a practical tip from the source that often gets overlooked. Coins in smaller bars are generally much easier to sell than, say, large kilo bars.
Oh,
So they offer more flexibility if you ever need to liquidate part of your holdings quickly.
that's really useful. Okay, so physical gold is one strategy. What else?
Beyond physical gold itself, the article really emphasizes a fundamental principle of risk management: diversification across other assets.
The classic advice.
Yeah,
Don't put all your eggs in one basket.
absolutely. That's the core idea.
Yeah.
Spreading your investments across different asset classes to reduce your overall risk. So while gold can be a really valuable component, it shouldn't be your only investment. It's about building a portfolio that can weather various economic conditions.
Right. So what does the article suggest combining gold with?
Well, it specifically points to assets like stocks, for example.
Yeah.
They can provide growth potential and dividends, things that gold inherently lacks.
Okay.
And bonds, which can offer greater stability and regular income, helping to balance out the volatility that gold sometimes exhibits.
Makes sense. Anything else?
Real estate investments, too. They can potentially contribute passive income and long-term appreciation. It's all about creating a mix that works together, creating a more balanced and hopefully resilient portfolio.
Okay, diversification. That seems key.
Yeah.
Is there another strategy for managing, say, the price swings, the volatility?
Yes, another powerful strategy the article mentions to minimize losses is dollar cost averaging, or DCA.
Ah, DCA. Heard of that. How does it apply to gold?
Well, it involves investing a fixed amount of money in gold at regular intervals, say every month or every quarter, regardless of its current price.
So you just keep buying, whether it's high or low.
Exactly. And the benefit of this approach is that it can truly help you avoid the pitfalls of trying to time the market.
Which is notoriously difficult, right?
Incredibly difficult, even for seasoned pros. So DCA helps reduce the impact of that volatility on your overall investment cost. If you consistently invest, say, $200 in gold every month, over time, this averages out your purchase price. It smooths out the highs and the lows.
Okay, that sounds like a much less stressful approach than trying to guess the peaks and valleys.
For most people, yes.
And finally, going back to physical goals for a moment. If you choose that route, secure storage solutions are obviously critical. What does the article say about options there?
Yeah, non-negotiable, really. The article outlines several options: home storage, bank safe deposit boxes, and professional vaulting services.
Okay, what are the pros and cons?
Well, each comes with its own set of considerations, right? Home storage offers convenience, sure, but naturally higher risks of theft or damage. If you go this route, the advice is invest in a high-quality safe and definitely consider insuring your gold separately.
Right, what about banks?
Banks' safe deposit boxes offer added security, but they might limit your access depending on bank hours and, well, policies.
Okay. And the third option, vaulting services.
Professional vaulting services. These offer the highest security facilities, often climate-controlled, fully insured.
Sounds expensive.
It is generally more expensive, yes, but it provides significant peace of mind and often convenient access, sometimes even online portals to manage your holdings.
It makes you think, doesn't it? Is that old shoebox under the bed really the safe haven you envisioned for your shiny assets?
Probably not the best long-term plan.
Okay, so we've covered how to safeguard your gold investments, how to manage the downside, but it's not just about protection, is it? Let's flip the coin.
Yeah.
How can we actively enhance their performance and, push closer to our financial goals?
Yeah, maximizing returns is equally important, and it requires a more proactive approach, definitely not just passive holding. The article outlines how to be more strategic in sort of enhancing the performance of your gold investments. One method that often comes up is, well, timing the market.
Ah, the holy grail of investing.
Exactly. Timing the market involves the, let's say, ambitious strategy of buying gold when prices seem low and selling when they seem high.
Easy to say.
Very easy to say. This, of course, requires a deep, deep understanding of market trends, complex economic indicators, investor psychology. It's a lot.
And while that sounds like the ideal scenario, the article strongly cautions, and I think this is important, that predicting market movements accurately is incredibly difficult.
Extremely.
And mistimed decisions can lead to significant losses. It's almost like trying to catch lightning in a bottle, isn't it?
That's a good analogy. It really suggests considering other, perhaps more reliable strategies, like the dollar cost averaging we discussed, if you're not confident in your ability to consistently time the market, which, frankly, most people aren't.
Right. So if timing the market is tricky, what's a more practical approach for maximizing returns?
Like regular portfolio monitoring sounds simple, but it's crucial.
Just keeping an eye on things. How critical is this for making informed decisions?
It's absolutely critical. Regularly reviewing your portfolio enables you to make those informed decisions and adjust your strategy as needed. Don't just set it and forget it. The article advises setting specific intervals for these reviews, maybe quarterly or annually, whatever works for you. And during these check-ins, you should assess the performance of your gold investments, yes, but also consider any shifts in your own financial goals or your tolerance for risk. Then adjust your allocation accordingly.
Right. Your life changes. Maybe your portfolio needs to change too.
Precisely. The biggest mistake people make here is simply setting and forgetting. Markets change, your situation changes.
Okay. And given that, even if we're not trying to perfectly time the market, we still need to understand it. What are some of the crucial economic indicators we should be keeping an eye on when it comes to gold? What do they tell us?
Yeah, leveraging economic indicators is a powerful way to make more informed decisions, even without trying to pinpoint exact tops and bottoms. Key indicators to watch include things like inflation rates, interest rates, and, as we discussed, significant geopolitical events.
Okay, how do those connect?
For instance, rising inflation rates often lead to higher gold prices, historically speaking. So that might suggest it's a potentially opportune time to invest or hold.
Right.
Conversely, falling interest rates can also boost gold prices. Why? Because they reduce the opportunity cost of holding a non-yielding asset like gold compared to, say, interest-bearing alternatives like bonds.
Ah, okay. That makes sense. So lower rates make gold relatively more attractive.
Often, yes. It's about relative value.
So bringing this all together, what does this mean for you, our listener? It really sounds like it's all about finding that sweet spot, doesn't it? Between protecting yourself and aiming for growth.
Precisely. That's the balancing act. The final piece is synthesizing all this information, the risks, the mitigation strategies, the return enhancers, and tailoring it to your personal situation. It's really about aligning your investment strategy with who you are as an investor, your goals, your comfort level, aiming to build a more resilient and hopefully profitable portfolio in the end.
And where does that journey begin?
It really begins with evaluating your personal risk tolerance.
Okay, risk tolerance. What does that actually mean in practice?
Well, your risk tolerance isn't just about how much you can afford to lose financially, though that's part of it. It's also about what you're willing to endure psychologically in terms of investment fluctuations.
How much ups and downs you can stomach.
Exactly. It involves considering your financial goals, your investment horizon, how long you plan to keep your money invested, and your genuine comfort level with market volatility. For example, if you have a long-term investment horizon, maybe saving for retirement decades away, and you're comfortable seeing short-term paper losses knowing it might recover, you likely have a higher risk tolerance.
Okay. Conversely, if you need access to your funds in the near future, maybe for a house down payment, or you're simply uncomfortable seeing those big swings.
Then you probably have a lower risk tolerance, and your strategy should reflect that. Perhaps less allocation to volatile assets like gold, or maybe none at all for that specific goal.
And beyond just tolerance, our specific financial goals, retirement, house, education, they play a big role in shaping the strategy too, don't they?
Absolutely. Your goals are the why behind the investment. They directly influence how you strategically allocate your assets. For instance, if you're saving for a very long-term goal like retirement, you might allocate a, let's say, moderate percentage to gold as that long-term hedge against inflation and economic uncertainty.
Right.
But for shorter-term goals, you'd likely prefer more liquid, less volatile investments. Stability becomes more important than potential long-term hedging.
Makes sense.
Mhm.
And critically, throughout all of this, the importance of just staying informed.
Mm.
That seems paramount, doesn't it? It can't be overstated in managing these risks and maximizing returns.
It's absolutely paramount. Regularly reading financial news, following credible expert analyses, monitoring those key economic reports we talked about,
Right.
it all helps you make significantly more informed decisions. And the article also wisely suggests considering a consultation with financial advisors or investment professionals.
Especially if things feel complex.
Exactly. For personalized advice tailored to your unique situation, especially as your financial situation evolves over time.
Great advice. Now, let's maybe hit some of the most frequently asked questions that kind of cropped up implicitly or explicitly in the source material. First big one. Is gold truly a good investment during economic downturns?
Well, it's often considered a safe haven asset, yes. Historically, its value has tended to rise when other investments decline. However, and this is crucial, it's not entirely risk-free even then. It can still experience price fluctuations, sometimes significant ones, even during periods of broad economic distress. Its behavior isn't always perfectly inverse to other markets.
Okay, so safe haven doesn't mean guaranteed profit or no risk.
Got it all.
Got it. And the perennial question, what percentage of my portfolio should ideally be in gold?
The magic number question. The truth is, the ideal percentage is highly personal. There's no single right answer.
Depends on the person.
It truly depends on your individual risk tolerance, your specific financial goals, and your investment horizon, as we've been discussing. That being said, the source generally suggests somewhere in the range of, say, 10% to maybe 20% as part of a well-diversified strategy could be reasonable for some.
Okay, a guideline, not a rule.
Exactly. But it can certainly vary based on your unique circumstances and your overall comfort level. Some might have less, some maybe slightly more if appropriate for them.
Right. And finally, let's revisit geopolitics. How exactly do those events affect gold prices? Just to recap.
Sure. During times of heightened tension or global uncertainty, think wars, major political crises, trade disputes, investors instinctively seek the perceived stability and historical security of gold.
So demand goes up, price goes up.
That tends to drive up its price, yes.
Perfect.
Conversely, when geopolitical tensions ease and a sense of stability returns, that fear premium can evaporate. Capital may then flow back into riskier, potentially higher growth assets, and gold prices may decline as a result.
Okay, that's clear. So, wrapping this up, there you have it. Gold isn't some magical risk-free asset. That much is clear. But when you really understand its complexities, the volatility, inflation impact, counterparty risks, and you manage them strategically with things like diversification and maybe DCA, it can absolutely be a valuable and perhaps even an essential part of a well-thought-out, diversified portfolio.
Yeah, I think this deep dive really underscores that. While gold has its traditional, sometimes almost romanticized role, truly understanding its complexities and how to actively manage both its risks and its potential returns allows you to make far more informed decisions than simply, following a generalized belief or a catchy headline.
Absolutely. Which leads to maybe a final thought for you, our listener. Considering all we've discussed about gold's dual nature, it's both a safe haven and an asset subject to significant volatility. Perhaps the real safe haven isn't any single investment, not even gold. Perhaps it's the continuous act of becoming deeply informed, rigorously evaluating your own personal circumstances, and constantly adapting your strategy to a world that's always changing. What does that idea mean for your approach to finding stability in your portfolio? Something to think about.